In this training video, we're going to talk about how to analyze multiple exit strategies after you bought the house with cash, starting with if we flipped and sold the property after we fixed it up. Then we're going to talk about and analyze how you would rent the property, then a lease option, and then a seller financing. So we're going to analyze a property in multiple different ways from an exit strategy point of view. So here we go. This is Chris Goff, and in this training video, I want to talk about purchasing the property and then fixing it up and selling it. We want a qualified buyer to move into this property. Let's get into it. All right, so as I scroll down, 415, we're going to buy it for 285. Now, that purchase price was originally determined in step 4 of every property and running through my all cash offer formula of what we could pay the seller. So I would highly encourage you to do that first if you haven't already done that. The square footage and then the cost per square foot. Now, the repair cost went through the property. It's $48,000. Use a hedge expense of 10%, which is nothing more than a buffer. Added repair costs just in case your original analysis was incorrect or leaky pipes behind the walls, things of that nature that you didn't see originally. Estimated repair period, I'm going to put 2 months on this property. Other costs, monthly holding, you can hit the plus symbol and get more, fine tune these numbers in each category. I was just putting an overall number in here, as well as closing costs. You could do the exact same thing. All right, so property insurance, $1,100, property taxes, $4,500, and then $200 HOA dues on this property. Then we get down into the financing side of it. Now, in this example, I'm just giving an all cash example, but we do have multiple ways to finance this and analyze these finances from hard money, private money, one of my favorite, or just a normal loan fixed arm. And when you do select these different items, you're going to fill in those blocks as well. But in this example, just using a cash example. All right, so now let's go look at how we're going to sell this property. So the very first thing, estimated asking price, $415. That's assuming that, hey, somebody just comes in, full price offer. You know as well as I do that usually does not happen, so you can adjust this accordingly. Estimated months to sell. So not only 2 months to fix the property up, I'm also calculating 3 months, just a precautionary on selling it. Any marketing cost, and again, you can expand these down just to kind of fine tune that, as well as selling cost all the way down to the real estate commission. Now you can analyze the analysis here. You can see the numbers, 33,753. Your return on investment, 8.85%, cash on cash. You can then print this, or you can also save this particular analysis so you can come back to and see how you did, and also use it in comparison to maybe some other exit strategies. So we're using rent as the analysis here. So monthly operating income, I'm going to put in 2,000. You can actually go in and even have multi-units and calculate, or if you're, renting in a college area, maybe you rent each bedroom. You can analyze that as well in multiple different ways. Estimated vacancy rate, I put 10%, and then monthly operating expenses. Again, you have so many different pieces here to this that you can really fine tune it, as well as adding additional columns here if need be. I just put in a total of 500. I can then go through my analysis at the very bottom and see my annual cash flow is 9,800 and my cash on cash return is only 2.84%. So I may use this analysis in comparison to maybe what if I lease optioned it? What if I seller financed it? What if I sold it? So it's a great way to analyze properties in multiple different ways. Now let's look at our exit strategy, or how we're going to sell this. And we've chosen a lease option. Now there's only a few different pieces to determining a lease option. Number one is the sales price. What are we actually going to sell this for? So after me fixing this property up and doing a lease option, I'm going to put this at tip-top price. So $415. Option payment, or what we call the down payment, I'm going to ask for $12,500. Monthly rent payment's going to be $2,000. I'm not going to give any monthly credits in this example. Used to do this all the time. If you do give a monthly credit, which is I'm going to credit the buyer each month, let's say $100 per month, as long as they pay me on or before the 5th of each month, towards the sales price. So it's an incentive for the buyer. I generally don't do it, but if you do it, just go ahead and keep those numbers low. And then how long of a term am I going to go with the new buyer? Always go 12 months with the new buyer. If I need to extend the term, I can. If I need to find someone else, I can. If I decide to sell it when they don't buy it, then I can do that. So I have definitely a ton of options if they don't buy, but obviously my goal is to get them qualified to buy this property. Now, as we scroll down, you can actually look at the analysis as well as the profit centers that you're going to have. So in this example, I would profit $87,000 just by buying it this way and then selling it this way, which would be a lease option. You could then. Now on the selling side, I'm going to scroll back to the top and let's look at the seller finance. And that's the strategy I'm going to use, or that's my vehicle I'm going to use over here to make money with. So estimated purchase price is going to be $415. Loan amount's going to be $415. Anytime I sell or finance a property, and especially after I've fixed it up, it's going to be full price, if not a little bit more, because we are actually financing it for the buyer. Down payment in this example is $25,000 at 6% interest. We're going to amortize this over 30 years to keep that payment just as pretty much a normal loan you would get at Bank of America, Wells Fargo. The difference is what we call loan balloon term. So the buyer here is going to pay me for 5 years or up to 5 years, meaning that, hey, I'm going to receive payments up to 5 years. And then whenever they are ready to cash me out, we will then check the balance. So we'll be able to amortize everything and find out exactly what they owe at the end of 5 years or before. So they could cash me out even sooner. Property taxes, property insurance here, HOA dues, those numbers obviously would just carry over to the new buyer. You can then see the analysis kind of broken down here. From the first loan, the loan with the buyer, as well as your profit centers. And if I scroll down, you can see my total net profit, my return on investment, my cash on cash. One thing that I want you to notice is this, in this particular example, cash flow is at a negative 2205. So either I need to reduce my cost on the acquiring side somewhere, or I need to increase the cost on the buyer side, unless I'm willing to accept a negative cash flow. So you can see I'm making money in other places, which the big piece here would be the sales price once they buy, but I wouldn't really realize my profit until they bought. And this is where you get to go back and start running these numbers, because I think sometimes we generally throw numbers out there. It's like, oh, it's going to work. And then you do the deal and it's like, why am I not making any money? And that's what Deal Pro is all about. Now I have the option to print this. I can save this particular offer, review this analysis as needed. So this is how you're going to purchase the property, and this is how you're going to sell or finance getting rid of it. Thanks for watching. Look forward to seeing you on the next training video.